Thanks, George. Good afternoon, everyone. I'm Kevin Testo. I'm a partner with the Bonadio Group. Just a little bit about our firm. We're a statewide CPA firm. We have offices all the way from New York City to Buffalo. I'm centrally located, I guess, in the state in Albany. Spend time all over the state, and I concentrate on nonprofits and specifically independent schools like yourselves. Last week, I did a webinar on the changes to the 990. I'm sorry, the no changes to the 990, but today we're talking about the changes in the accounting world. So this session is going to be a lot more technical, I should say. I'm assuming everyone on the call is somehow in the realm of accounting or finance at your school. If you're not, it's still okay. You just may be bored for the next 55 minutes. However, if you're not in the finance realm, it is somewhat important to know how much of this is going to affect your finance team at your school, because from what we're understanding, there's going to be a lot of time to invest ensuring that everything is up to speed from a disclosure standpoint, and that your board is well aware of what's going to be changes in the financial statements. So that's just a little bit of background. I'm going to share my screen here. Just bear with me, and I'll bring up our slides that we're going to walk through. Okay. So there's that. Okay. So I'm assuming everyone can see the slides. Okay. Okay, so today we're going to talk about the new ASU, which is the accounting standards that are put into effect by FASB, our Financial Accounting Board. And really, this is a FASB that's been long overdue. And really, what's key is that we haven't seen a major overhaul in the nonprofit accounting realm in probably the past 30 years. So that's why this is really so significant. Just a little bit of background on this ASU. It talks about changes in the nonprofit world, started back in 2008, 2009, where the advisory committee really tried to come up with some ideas for enhancing the financial statements of all nonprofits. Keeping in mind, this is not specifically related to schools or independent schools. This will affect any nonprofit, regardless if you're a hospital or a nursing home or a museum or an independent school. But back in 2009, they started talking about this, and in 2015, an exposure draft was put out there. You may remember that exposure draft, because all nonprofits as well as CPA firms were allowed to comment on the exposure draft. And as you would expect, there was over 300 letters that came out talking about what was working and what was not working with the draft. One of our letters came from our firm because we represented many nonprofits here in the state. So it turned out that they threw a lot out, but they kept a lot in. So what I wanted to do today was talk about what for sure will be changing, remind you a little bit of what isn't going to be changing yet, and then we'll talk about really what it's going to take from a time perspective on your end, and what you should be sharing with your boards now so you're ready for this implementation for next year's financial statements. So that's really what today's agenda is going to be about. As George said, you can take these slides with you at the end. They will include some good disclosures and footnote examples that you can start with. So that's my little present to you. So that being said, we'll go ahead. Typically, it's taken about 40 to 50 minutes, so I have left enough time, plenty of time to ask questions. So please interrupt me if you do, or I'll stop at certain break points throughout to talk a little bit about anything you want to. So just a little background to remind everybody that this is not a complete overhaul of all the accounting rules that we know. It's really just an update to make sure that nonprofits really tell their story in the way that they're designed to. The FASB, as I mentioned, wasn't happy with the way everybody was creating and disclosing their financial statements because everybody was doing something a little bit different, and we'll talk about that. But there was really a lot of unknowns about liquidity of an organization and their current cash flow status. Yes, someone could look at the cash flow statement to try to understand an organization's position, but the FASB really wants to put that in words, and we'll talk about that. The net asset classification that we currently know was very confusing. We really didn't know really what it meant to have a temporarily restricted net asset versus a permanently restricted net asset. Maybe you and I did because we're accountants or in the finance realm, but the general public didn't really understand what that all meant. So this is really what sparked this update that was vastly needed. And if we can see on this slide, these are the areas of focus. These are the areas that we're going to talk about today. And we've really broken my presentation down into really 3 sections. So we're going to talk about net asset classifications and how they're changing, as well as the endowment fund accounting and disclosure. So there's going to be some requirements there. Then we're going to talk about the expense reporting and disclosures and how that is changing. And then I think the most important piece is the disclosure about liquidity, because this is really going to be brand new. That's going to have to go in your footnotes of the financial statements that everyone's going to read. And when I gave you an example of something that the board is going to want to be on board with, it's definitely going to be this last bullet with the disclosures about liquidity. Okay. For those of you who may or may not be following on what was going on with the exposure drafts, you may have seen these items: operating measures, the realignment of the cash flow statement, and then exploring segment reporting. I'm not going to go talk about these because these are the items that were put on hold. Because they are technically listed as FASB research right now, we are not expecting them to be implemented anytime soon. So phase 2 is on hold. This has nothing to do with what will be implemented going forward for the next year. So I just wanted to address that in case anyone is really looking to get some information on this. So there's just been too many disagreements on these complex areas. So the FASB said, you know what? We're going to throw it out and we'll look at it at some other time. So let's go into the first major change, the net asset classifications. As I talked about, do we really understand, and I say we, meaning everyone who's reading the financial statements, do we really understand what unrestricted net assets is? Because currently there could be items in there that have to do with escrows or any type of legal restrictions. We currently show them as unrestricted, but are they really unrestricted? Temporarily restricted net assets has become a hodgepodge of different information. Endowment related investment income related to endowments are sometimes thrown in there. And MIFA, when that was enacted about 5 or 6 years ago, muddied the waters even more. So it's really to help the reader understand and to even track internally on the net asset classifications. So how is this changing? Well, if we look at this slide, we currently know right now the 3 buckets under current GAAP: unrestricted, temporarily restricted, and permanently restricted net assets. With the new ASU, we are simply going to get rid of the 3 buckets and go down to 2 buckets. Those 2 buckets are going to be called with donor restrictions and without donor restrictions. It's as simple as that. The only items that are going to be reflected with restrictions are those that were received by donors. So any type of board designated funds, well, those aren't restricted by a donor, so they will be considered in the bucket of without donor restrictions. So with that, with those two buckets now, is also going to require disclosures, and we'll talk about that in a minute. Currently, we really don't do a good job, or GAAP doesn't do a good job of requiring of the reader or the preparer to show the reader of what's in those buckets. And currently there's some mixes of, some folks do present it, some folks don't. As we'll see in a minute, this new requirement is going to disclose all the detail that's in both the without and with donor restrictions. So, as I mentioned, these terms are now gone. We don't want to even talk about them. Temporarily and permanently restricted are no longer. Even unrestricted is no longer. It's simply with or without donor restrictions. So it's going to be hard for someone who grew up in learning these methods of nonprofit accounting to change our language. So the quicker that you and finance change, the quicker that everyone else using your financial statements will change as well. So here is an example of what the statement of financial position will look like. As you can see at the bottom, net assets are simply those two buckets as we now know them as, with or without donor restrictions. Pretty simple. So I was mentioning that the breakout is going to be needed for to disclose it, what's within and without donor restrictions. So the next slide really shows the breakout. You can see the with donor restrictions includes perpetual in nature. These are your technically endowment funds that you're only going to use the investment income on. So that's listed on the first line. Purpose restricted, these are your typical, what we now know as temporarily restricted net assets, which are going to be used for a specific purpose. And then the unappropriated earnings, as we now know, those are the earnings that the board under the MIFA may set aside to say these are to be used for future periods, the income and earnings on the endowment investments. So you can see that those are broken out within the with donor restrictions. And then without, you're really not going to have much breakout there. It's if your board has designated any type of endowment funds, and then everything else that's not restricted by a donor. So I will point out that this breakout has to be shown, but you do have an option. You can show it on the face of your balance sheet if you think you have enough room, or you can simply put it in a footnote to the financial statements. But overall, your total net assets will agree back to the face of the statement of financial position. So the new requirement is now to go into even more detail. So this is your basic summary breakout of what's in each bucket. But now we need to go into more detail on what is included within the with donor restrictions. So you can see here the 193,413. So if we turn to the next slide, this is the breakout, and it looks like it's cut off, but it does total down to the 193,000. So this is the breakout that's now going to be required in the footnotes, and this is a pretty robust example of the footnote. You may not have this type of level of detail at your school, but you can see all of the items are listed out by the different type of activities or projects or programs that you're having. So the first column, or the first quarter, I should say, of the spreadsheet that totals down to the 10,601. That is the amount that's going to be restricted for a specified purpose. You're currently, I look at it as your current temporarily restricted type of net assets. Moving down, you can see the amounts that are subject to the passage of time, which is the 3,000. But more importantly, the subject to spending. This is the assets that are restricted for endowment type of purposes only. That's 174,000. And all of these subtotals would agree back to the previous slide. I'll go back to show you right here. So you're really just giving the reader more detail on what's included in each one of these three buckets. Okay. Again, you'll get to have this, and this is just a starting point of what that disclosure would look like. So you can use this to start showing what it would look like. And then finally, I mentioned the unrestricted piece. Well, the new requirement in this ASU is for the board's the board designated endowments to be listed out in detail. Right now, it's a 50-50. Some folks like to disclose what the purpose of those board designated endowments are. Some really don't. They may just show it as a line and the dollar amount. This new footnote is going to show really how much the board has designated and really the purpose behind it. Not a big deal, but it is a change that we now are seeing. So I'm going to stop right now. That was a lot to throw at you right in the beginning. See if anyone has any questions on the changes in the net asset buckets.
And remember, all you need to do is unmute your microphone and just jump right in.
Okay. All right. So yeah, I'm a little unclear. I'm guessing most of you have at least heard of these changes, but maybe this is your first time. I'm not sure. So there's been a little bit of drip, probably from your current CPA firm. And again, we are still learning more and more about it. But this is as much as we know currently on what this is going to look like. All right, so hearing none, I'll just keep moving on. The other major change has to do with underwater endowment funds. You may have heard about that term before, and I think we all somewhat understand what underwater endowment funds are. Well, this is the first time that the FASB has actually come out with a definition of what an underwater endowment is. So it is great now that we do have some definitions in our accounting language, which basically says that the donor restricted endowment fund for which the fair value of the fund at the reporting date is less than the original gift amount. So if someone gave your school $500,000, but the market tanked during the year and that value is now $300,000, well, technically that fund is underwater. So now we have an accounting definition that came about in this new ASU.
Kevin, sorry to interrupt. I have a question that came in on the chat, maybe just a little too slow to catch you at the last break.
Yeah, sure.
And the question is, will boards still be required to release from restriction in accordance with NYP MIFA?
Will boards still be required to, what was that, George?
Release from restriction?
Release from restriction. So maybe what the question is related to is the endowment related investment income. I guess I don't know the answer, or I don't understand fully. Maybe we can just talk about it.
Okay, that sounds great. So thank you very much. And Lindsay, we'll get more details from Lindsay, who's not working with microphone today. So,
Okay.
Sorry to interrupt.
And maybe this will help. So the underwater endowments that we are currently talking about are going now to be recorded in net assets with donor restrictions rather than assets without donor restrictions. So technically, because that fund is underwater, it's still restricted by the donor. So it's going to be recorded in the donor restrictions bucket as we now know. But this is what's really key. And this is where you may or may not have this in your financial statements, but now it's required. The new ASU is going to require disclosures of the board's policies to spend or not spend funds that are technically underwater. And this is an example. The underlined sentences are what would be added as new disclosures. And you can see, I won't read it all, but you can read it yourself and say, in the underlined area, it says the nonprofit has a policy that permits spending from underwater endowment funds. Right there is a good opportunity now for one to say, okay, do we have a policy? And two, are we okay with the way it's worded, because now it's going to be included in the footnotes to the financial statements. So this is one of your takeaways that you may want to bring back to your board to say, okay, where does this stand, and is everybody comfortable with it? The next disclosure, here's another example. This one's a little more easy to read, I think, and you can see the item that's underlined is deficiencies of this nature, which means that the fair value is now below the original amount, exist in 3 endowment funds, which together have an original gift of $3,500. So you're telling the reader what the original amount was, and now it's deficient by $200 because the current value has dipped to $3,300. So you're really giving more transparent information to the reader, as opposed to just putting totals on your endowment footnote right now. But again, it's about policy and disclosing what exactly happened during the year. We didn't make these disclosures up. These came right from the ASU, so I just want to make that clear as well. So did any other questions come out about that? I see something flashing.
Yes, I just wanted to know that this has to be done per individual donor, correct?
It can be tracked by individual donor, but the disclosure can be simply on a total level.
Okay.
Because you can see in this one, you can say, yes, we have 3 endowment funds, but in total, this is what's happening.
Okay, and is it just for the current year monies that we receive? We don't have to go back to prior years?
Correct.
Okay, good.
Yeah.
Thank you.
I'll talk about the implementation date, but I'm just, as of right now, I'm assuming most of you are June 30th year ends. So this will not affect you for this fiscal year, but it will be the June 30th, 2019 year end that this new accounting standard will have to be implemented. However, I'll give you a warning. The new accounting standard is retrospective. So you will have to go back and at least show the information for 2 years, both for 18 and 19. So that's why it's important to think about it now, because you're going to try and start gathering this data for the year ending 18. Okay. And when we get to expenses, you'll see why that's important. Okay. So the next slide, this probably won't affect a lot of you, but it's important to note. So we currently have an accounting standard that allows us, if you were to raise money for a specific building, a purchase or of a construction of a new building, we currently have the option is to release those restrictions on the contributions that you brought in for the building of the building. You can release it over time. A lot of times it's over the depreciable life of the building, or you can release those restrictions when all at once when the building has been completed. So you have the option. I really don't see a lot of times organizations doing it over the life of the building, but it is allowed. So now with the new ASU, there's no more option. As soon as the building is complete and put into service, you have to release those restrictions all at once. So if you currently have any type of temporarily restricted amounts sitting there for the life of the building, you may have a $2 million amount sitting in temporarily restricted. Just note that when this accounting standard comes into effect, that will all have to be released all at once, simply because it's a change in accounting principle. So there's no longer an option. So I just wanted to remind everybody of that. Okay, so the next item really has to do with expenses. Currently, I'm assuming that everyone is showing the breakout of expenses a different way. The idea is to have all nonprofits present expenses in the same exact way. The only organizations currently that have to show both a functional and natural class schedule are typically health and welfare type of entities, nursing homes, hospitals. Well, you're in luck. You have to do it now as well. So the requirement is for all nonprofits to show a schedule, and that schedule is going to show both the natural class, which is salaries, benefits, depreciation, interest, and function. Function meaning program related, administrative related, and fundraising. And I'll show you an example in just a minute. But it's really to give the reader more information on how expenses of an organization are being paid, and to really streamline everybody's reporting in the same way. You probably have to do this, you definitely have to do this on the 990, but how often is that level of detail included in your financial statements? I don't know, maybe you do. In the ones that I do see this type of detail, it's sometimes in a footnote or sometimes in an attached schedule to the back of your financial statement. So this is going to give you an option, but the idea is that it has to be part of your overall financial statement. So it's a separate statement, or it's shown right on the face of your statement of activities. But it can no longer be a schedule that the auditor technically doesn't perform or give an opinion on. So now your auditor will now opine on the statement of functional expenses. So that's a big change. So in that schedule, just note that gains and losses, either on the sale of property or any type of gains or losses on investments, are not going to be included. And investment expenses are not going to be included. Investment expenses are now going to be shown net of any type of investment income or loss. You may currently show it net and show the breakout net of $400,000, or maybe you show it as a separate line item under expenses. Well, this is now going to streamline everybody to show those investment expenses included within your investment gains or losses. So that's going to be the requirement. And then you're going to have a disclosure of how you allocate amongst those functional buckets, which I'll show you in just a minute. So here's an example. So you can see, you can break out, program however you want. Maybe you run an after-school program. Maybe you have a summer program that you run. You would want to break those out into probably no more than 3 top programs. Then you would break out the expenses on a management in general type of column, and then fundraising. And overall, your total expenses would come down and be shown there. As you can see, there's a lot of detail here. So you have the option to put it on right on the statement of activities. I would recommend showing this as a separate statement, so you can make it as big or wide or whatever as you want. But as you can see, investment related expenses are not here. Any type of gains or losses are not here. However, depreciation is. And you can see depreciation is a key expense that would affect all types of programs and go over and affect management and general related expenses as well. So that's really what the disclosure of these type of expenses is going to require. And we'll look at that. The disclosure here is for any type of costs that benefit more than one function. So you're going to have to explain to the reader how you as an organization came up with that breakout. And in this case, you can see the depreciation on the building was allocated based on square footage. I know we don't have to go hire an engineer to do this, but it can be a rough estimate of how that's going to be allocated. Also, the president's office is allocated based, this is an example, on a time and cost study of where efforts are made. So if you have any type of expense that's, perhaps, maybe salaries. Salaries can obviously go over the 3 different programs that you have. So how, as an organization, are you determining how you're allocating those salaries to each of the programs, as we saw here? So it doesn't have to be detailed, but you have to have some type of justification and summary of how you come up with the allocations that you're showing here. So again, another item that you may want to draft now, maybe you don't have a policy right now. So you may want to start thinking about it and putting it to paper so that when it goes into the financial statements in a footnote, everybody's on board and there's no surprises. So as I mentioned, the investment returns, those will be reported as part of your overall investments earnings. So this is good news. You're not going to have to go to your statements and try and pinpoint what those investment expenses were. And a lot of those investment statements are hard to read, and it's really hard to find what those expenses are and how they netted it against them. So the good news is you don't have to report them on a detailed level anymore. The components of investment return are no longer be required in that investment footnote disclosure, as you know them. Typically right now you see interest and dividends, unrealized gains, realized gains, and then investment expenses. You see that type of table that's broken out. Good news is you don't have to show that level of detail anymore. So there is something good that came out of this from, well, I think it's all good, but not time consuming, I should say. So again, I'll pause right for a minute. The last piece is about liquidity, but I'll just make sure no one has any questions on the functional expense requirements.
I had a question going back when you were speaking about buying the assets for the building. Does that also relate to construction projects on existing buildings or just new buildings?
So it would be required for any type of building that you are taking in contributions for.
So if we're doing a capital campaign for a rooftop playground, that would be part of that.
Exactly.
Okay.
So, yep.
Thank you.
You're welcome. Okay. So hopefully everyone has the capabilities right now with your GL system to run this type of detail that's going to be required in this table. There it is. And if not, that's something you're going to want to go back and try to understand, because, as I mentioned, even though it's not required for 19, until 19, this is going to have to be shown for the 18 year as well. So you have a year now to try and figure out, does your GL system produce this type of capability? How hard that task is going to be, I don't know. I guess that's what you're going to have to try and figure out. Okay. All right. So the last piece has to do with liquidity. And this is probably the most, I don't know, most significant changes that maybe the board won't like. And I'll show you this in just a minute. But really, the FASB currently believes there's not enough information in a financial statement, in layman's terms, for an average reader of your financial statements to tell if the organization is healthy, it has the liquidity to continue operating for at least another year or two, based on the assets that you currently have. So the new change is going to affect two things. You're going to have to disclose qualitative information, which is really a narrative of your process of how you manage your liquid assets, and a quantitative, which is the numbers piece. And we'll show you a table, but it's going to be some eye-opening to a lot of folks. So the quantitative piece is really going to disclose to the reader what are your true liquid assets that you can use within 1 year. So you got a qualitative, which is the description of the process, and then the quantitative, which is going to be the table. And I'll show you an example of both of those. So on a qualitative level, this is really the information that you communicate to the reader of your statements on how liquid your resources are and what you are doing to manage those. What are your policies that you have in place that would establish reserves, or your means to draw on a line of credit? And if you don't have a policy, this is something that I would write down to say, okay, we need to re-examine this and make sure that we, management and the board, are all set for this type of disclosure. And here's the example that comes out of the ASU. There's a lot of information here. You can read it at your leisure. But it's basically telling the reader how the organization is supported by various different means. So keep in mind, you want to disclose to the reader how quickly you can pay off current obligations using the current assets that you have. And I say current, within the next 12 to 20 months. It's kind of rubbing the crystal ball a little bit and seeing what you have coming down the pike and what do we have currently to use to pay for those obligations. So I'll highlight here, right in the middle, the organization invests cash in excess of daily requirements in short-term investments. Occasionally, the board designates a portion of any type of surplus to its liquidity reserve, which is great. But is that your policy? That's something that you're going to want. If needed, at the bottom here, you can say, in an event of any type of unanticipated liquidity need, the organization can draw on a line of credit, which you already will probably disclose in your footnotes, but this is part of the process and narrative that the board has set up that you're going to want to disclose to the reader of the financial statements. So this is one good example. I would use this as a template to kind of start with and then see what management and the board has to add to it. So from a quantitative standpoint, this is where it gets interesting, because you're now going to have to show a total of what those assets are that are available to be used, just like as you disclosed in your narrative. So you're going to start with those financial assets. You're not going to include any non-financial assets, such as PP&E, inventory, prepaids. So for the most part, you're going to start with the number that adds up to cash, investments, and receivables. You're going to include or exclude any of those assets that are restricted. And that could be restricted in terms of board designated funds. So any of those items that are unavailable within 1 year will not be included. So let's look at the example. So this table is going to be required to be disclosed right under the narrative that we just talked about. So you can see in this example, financial assets are $234,000. Those are the amounts, as I just said, investments, cash, and receivables. However, what is really available to be used, right? There's a bunch of different items that you can think of probably that are technically restricted in nature that shouldn't be included in those financial assets. So as you can see, restricted by donor with time or purpose restrictions. In other words, $11,000 that you want to take out right there. And these are all probably in your investment portfolio currently. But you got to think about what did I show as those amounts that were included in the bucket with donor restrictions, right? The ones that we talked about in the very beginning. You got to back those out of the assets that you have at the end of the year. And you can see here the board designated funds are also being backed out. So when establishing the board designations, the board should think about, okay, it's fine that we're designating these funds, but we're going to have to show it in the table as being restricted technically by the board. So at the end, you can see this number at the very bottom of the table. $5,000 in this example are the only assets that are available to meet the cash needs for 1 year period. So in this example, we went from $234,000 to $5,000 very quickly. So this can be very eye-opening to many people, including the readers of your financial statements. It's quite possible that that number at the very bottom could be a negative number. We're expecting that to be occurring. So what we're urging all of our clients to do is do this example now, do a little table and see what it would look like if you had to implement it right now, and show that to your board, because the good news is you have a year to think about it, but it is going to be required come June 30th, 2019. So if this is helping the whole nonprofit world, I don't know, but the FASB thinks it is. So it's really going to be showing who's really healthy and who's not. So banks are going to have to get used to looking at this type of table. Donors are going to have to start looking at this type of table. So the more you educate them now, I think the easier it's going to be in a year. So just to conclude on one item here, cash flow statements. There was talk that we had to move to the indirect method when this preliminary FASB came out. Just want to rest assured you still have the option to do direct or indirect. I see indirect method probably 99% of the time. So continue doing what you're doing on the cash flow statement. You don't have to change that. There was talk about this, but that is on hold as well. So finally, which we'll have plenty of time for questions, I just want to show everyone, I think everybody knows that it will be required for the June 30th, 2019 fiscal year end. By any chance you are a calendar year end, it will be required to be implemented by the December 31st, 2018 year end. You will be showing this as a change in accounting policies. Typically note 1 or note 2 to your financial statements have your accounting policies all listed out. And then at the bottom of that note, you'll show accounting change, and this will be an accounting change, the implementation of FASB, or I'm sorry, ASU 2016-14. So you can work with your accountant and auditor to make sure that's disclosed the proper way. So this is really everything that we talked about. You know, I just continue to urge everybody to start thinking about it now, so there's no surprises. Once you adopt you have to adopt all the areas that we just talked about. You do have the option to early adopt. I wouldn't recommend it to my clients. I think we still have a year to start getting more and more examples of the disclosures that I just showed you. But keeping in mind, if you do want to early adopt, you have to adopt them all. You can't just adopt one or two of the items that we talked about. Here's a little timeline of where we are and what we started with, and you'll get all of these. So in conclusion, this is everything we talked about. Begin preparing now. Think about your board designated funds, what type of funds and the policies that you have for underwater funds. Think about how you're going to produce that master giant spreadsheet of expenses, making sure that you have allocations properly documented and everyone's on board. And finally, review that liquidity table, review the policy. Do it now. We'll make sure everyone's on board with it.